So we do have our first question. And the first question is it a good time to buy, or do you think the market will go lower? So who would like to go first?
Well, if you want me to take it, I'll give it a start. Well, the academic way to answer that question is really very simple, which is that their stocks are riskier investments than bonds, or especially safe bonds, and therefore you have an expected equity risk premium or higher expected but not guaranteed return over those treasury bills. So every single day you're not invested, you're giving up that expected premium. So the odds are against you if you delay investing. Now, with that said, we should point out that for many people, when the markets are falling, it creates a real problem for them to make that decision to invest. And so they freeze up and don't invest at all. So the way I try to help them think about that problem is first to note the markets are always risky. There'll always be excuses or reasons why you might want to delay investing, whether it's some geopolitical risk, a political risk, whatever it might be. Prices are high. There are all kinds of reasons. Once you delay investing, it's very difficult, if not impossible, to pull the trigger and buy, except probably after it's too late and everything looks safe and prices have gone way up. So the way to address it might be first recognize the science says the odds favor you investing all at once. So that's going to put the odds in your favor. However, if you're unable to do that, what you can do is set up a plan with your advisor. You might sit down with Adam and say, look, Adam, I just don't feel comfortable putting the money all in at once. Let's say put 1/4 of the amount today, and every month for the next 4, we'll add on the 9th of the month, 30 days from now, we'll add the other quarter, or 1/6 every 6 months, or worst case, I would say 1/12 every month for the year. You don't want to go too long because you're giving up a larger equity risk premium, remembering that markets on average tend to rise. Now, what you then should take is the attitude of this. When I ask people the question, say you put in 1/4 today and 1/4 each of the following quarters, I ask people, do you then want to root for the market to go up or go down? And the typical answer is, of course, they want to feel good. They want to root for the market to go up. And that's the wrong answer, because clearly you're going to be buying more in the future. And therefore you want the market to go down so you get a chance to buy low when you have higher expected returns than the other way around. So the way to think about it, which I think is helpful, as I tell people, first, the right answer scientifically is put it all at once. But if you decide to dollar cost average is the term, then here's what I want you to do. After you put the first investment in and the market goes up, congratulate yourself on your brilliant decision to at least get started, and you've got a nice little profit. And if the market did go down, congratulate yourself on your brilliant decision to not put it in all at once. And now you're getting a chance to buy cheaper. In either case, you were a genius, and you feel good about your decision and not look back and second guess. None of us has crystal balls that can tell us what the future will hold. So today, if I were an investor and I had an investment plan, all I would be doing is to look to rebalance, or if I had new cash, it would probably, of course, be going into things that have done the worst recently, which would be European stocks, developed markets, emerging markets, which have done even worse than the US stocks because they're more exposed to Russia. So that's the right way to think about that question, whatever is going on in the markets.
At the risk of piling onto a Larry answer, I would say this: make sure you own equities outside of your retirement accounts. So when you put that money in, if the market goes down and you congratulate yourself, so to speak, you also get to loss harvest. Because if you're sitting in equities in those retirement accounts and you've just watched them decline 10%, there's nothing you could do other than to rebalance. Whereas if in your taxable account, you could sell that fund, buy a similar fund, and participate when the market goes back, and you get the tax deduction.
And I'm going to take the liberty of quoting Larry to Larry. So this is the answer that I expected him to say. He said, do you really have any specialized knowledge that other people in the market don't have about Russia and Ukraine? So I don't know, maybe you're a tank manufacturer and you understand a whole facet of what's going on with tanks, and maybe you should buy or you should sell, or maybe you understand something about Russian intelligence or something like that, that might give you some information that the market doesn't have. That might be a better reason. But the truth is, the vast majority of us don't have that specialized knowledge. Larry, I was giving Larry some grief. Oh, gee, I don't really know about reinsurance, global warming, all these catastrophes. I just don't really feel comfortable. And he's like, you don't know anything that the reinsurance companies don't know. And then he told me all these reasons that they have taken into account, and that they have taken into account all the things I was worried about. And at the conclusion, I was really happy that I had money in reinsurance and some of the other alternatives that I suspect Larry's going to talk about before the end. So most of us just don't have any specialized knowledge about Ukraine, Russia, everything else, so that we should probably not necessarily think, oh, well, the market's going to go down further, because that's obviously going to happen because of what's going on in Russia and Ukraine, when we really don't know that. So how did I do, Larry, quoting you to you?
I feel really good that I've accomplished my objective as a teacher.